learn on the go, and stay informed. Our goal is to keep the average user informed and up to date with relevant tax information. For the entrepreneur and investor, getting acquainted with tax laws and regulations could be quite daunting. Well, not anymore. Introducing the KPMG Tax mobile app, where you can access all tax-related news, laws, and insights in one place. Also, calculating personal income taxes has never been quicker. To get the app, simply search for KPMG Nigeria Tax on Google Play Store or iOS Store and install. Once installed, quickly do a one-time sign-up on the application to access a constantly updated library of news, laws, and articles alongside easy-to-use tools. The KPMG Tax mobile app has a minimalist design, making it effortless to use and navigate. What's more, if you can't find what you need, asking a professional is as fast as it gets. Let's walk you through the application. The full menu is accessible from the left and helps you jump to any part of the application in seconds. Access fresh tax news by clicking on the news icon. The seamless scroll makes it simple to view all news at a glance. You have news you've already seen and want to go back to? Just search. Expand or share each news item to your friends with the dedicated buttons. Adjust your news preference easily from the settings icon and tailor your content. We have embedded tax legislation and popular cases in our tax laws section. Are you eager to know more about taxation in Nigeria? KPMG Tax app has more than enough for you. Stay on the cutting edge of industry updates with insights features. The new app brings together alerts, newsletters, articles, and publications from industry-leading KPMG professionals. You don't have to worry about missing important regulatory dates and other notable events. The notable date feature brings them all into one place in a calendar or list, however you want to view them. For the average employee, entrepreneur, or business person, KPMG Tax app has another important feature, the PIT calculator. Plug and play, simple as it gets. Input the required numbers and calculate your taxes. Also, the app has jokes and valuable tips. Check in to learn something new and fun. Still feel there's more to know? We've got your back. Ask an expert and get quick, insightful responses from KPMG professionals when in doubt. Learn more from various authorities through recommended links in the external links tab. Read all about us to find out more about KPMG's service offerings, our responsible tax principles, and disclaimer. It's now a breeze to connect with us online. Just click on the link icon on the homepage to get to us on social media. KPMG Tax app, connecting with you on the go.
Good morning. Welcome to our distinguished guest. It's a pleasure to have you on our May edition of the KPMG Social Media Tax Chat. Today is going to be a very interesting topic because we're discussing something that impacts us, the economy and the global economy as well. The topic for today is taxation of online businesses and its impact on local consumers. With me, I have Akinwale Alao. He's an Associate Director in Tax Regulatory and People Services, Consumer and Industrial Markets. My name is Elizabeth Olahere. I'm a Senior Manager in Tax Regulatory and People Services. So the topic for today has been picked because it is very topical, and it is also something that we need to prepare ourselves for as an economy. The pace of digital acceleration, transformation has been further even accelerated by the COVID-19 pandemic. And a lot of business models, as we know it, are changing to cater to the digital economy. And taxation also needs to increase at an accelerating pace. The government's global economies have recognized this fact. The OECD is working laboriously to come up with a position so that there's a cohesive method of addressing the challenges with the digital economy. Nigeria specifically has introduced the significant economic presence rule, which is a unilateral decision pending when there would be a consensus agreement. So we'll be discussing a lot about the significant economic presence rule, the nexus that has now been created for the taxation of online businesses in Nigeria. So I'll pass the baton over to Akinwale to introduce the topic, and then we can start. Thank you. And before we start, sorry, we have a chat box. We can take questions, all your questions, in the Q&A section. We're also streaming live on Twitter and Facebook. We'll also be addressing your questions that you have on Twitter. We'll be addressing them here as well. So Akinwale, over to you.
Yeah, thanks, Lizzie. You're exactly right when you talked about the digital economy. Over the last 3 decades, technology has completely revolutionized the way business is done globally. Online businesses have totally changed the world's business landscape. You have companies like Apple, Microsoft, Amazon, Google, and others that have become part and parcel of our daily lives. They've transformed global retail, transportation, entertainment, advertising, real estate, financial services. You just talk about it. To have an appreciation of just how massive the onslaught of online businesses have been, all you have to do is to take a look at the world's top 10 most valuable companies. When you look at the world's most valuable company, that's Apple. It's a technology company. And not just that, 70% of the top 10 most valuable companies in the world are now technology companies. Apple, Microsoft, Amazon, Alphabet, that's the parent company of Google, Tencent, the Chinese online gaming behemoth, Facebook, and Alibaba. 7 of the 10 top most valuable companies in the world. That just tells you how powerful online businesses have become in today's world's economy. Today in tax circles all over the world, one of the issues at the front burner is the taxation of the digital economy. Everybody is talking about it. Governments, tax administrators, tax practitioners, consumers, and we'll be talking about it today from a Nigerian perspective. One of the definitions of the digital economy that I like the most is that of the Asian Bank of Development, that defined digital economy as a broad range of economic activities that use digitized information and knowledge as key factors of production. Traditionally in economics, we were told that the 4 major factors of production are land, labor, capital, and entrepreneurship. And a lot of emphasis has always been placed on the first 3 factors. However, the digital economy de-emphasizes the importance of land, labor, and capital, and it accentuates the value of entrepreneurship, user participation, the generation and use of user data, direct and indirect network effects created by users, and that's why you can have WhatsApp, for instance, a technology company with just 50 employees that are largely working from home, that it would have a user base of over 2 billion in 180 countries. That's why you can have Paystack, a 5-year-old fintech company with about 100 employees, that will be valued at 200 million, which is more than 3 times the aggregate value of about 3 commercial banks in Nigeria. That's what the digital economy is about. Now, the reality is that tax concepts, for the most part, have also been built on the importance of physical factors of production. The international tax rules, for instance, have been fixated for decades on the need for foreign businesses to have physical presence or representation in Nigeria or in a country for them to be taxable in that country. But that's changing very quickly now. And it's good to know that Nigeria has joined the league of countries that have taken the bull by the horn in taxing the digital economy. So I really look forward to discussing with you today. I know that we and our listeners are going to have an exciting 2 hours today. Thank you, Lizzie.
Absolutely. Thanks, Akinwale, for that very detailed expose. I mean, I think what you've mentioned, therein lies the situation with your definition that you have alluded to from the Asian Bank. Therein lies the situation, the challenges with the digital economy, where there's not enough reliance on physical. There's no reliance on physical to demonstrate value. Instead, there's a lot of reliance on intangibles. There's a lot of reliance on technology and basically cross-border transactions, making the world a global village. So it's about how do you determine taxing rights? How do you determine user participation? And that's where cohesion comes in with taxation of the digital economy, because it just reemphasizes the fact that the world is a global village. In the way the business model is run is the same way taxation would have to be administered. And if anything, taxation has to be done efficiently. It must be done in the best possible means to ensure that the taxpayers and the local consumers are not burdened. So I think we've started off on the right path, on the right note. The chats are already buzzing with questions, and I think we'll just delve right into it. So one of the first questions we have here is, what is the general framework for taxation of online businesses in Nigeria? I think you already started to allude to it. So in a bit more detail, what is the general framework for the taxation of online businesses in Nigeria?
Yeah, thanks, Lizzie. That's a good question. Online businesses are first and foremost businesses. So the overarching framework for the taxation of businesses in Nigeria also applies to online businesses. Generally in Nigeria, businesses, whether online or brick and mortar businesses, can be liable to direct taxes on the one hand, or indirect taxes on the other hand. So they can be liable to direct taxes and indirect taxes. With respect to direct taxes, the tax status of an online business will depend on whether or not it is incorporated and the nature of the transaction from which it derives its profit. So if the business is incorporated, for instance, its tax profile will likely be determined under the company's income tax regime. If it is not incorporated, then the direct tax framework applicable to it will be the personal income tax legislation in Nigeria. And also, if the business carries on capital transactions from which chargeable gains are derived, for instance, it will fall within the purview of the Capital Gains Tax Act in Nigeria. And furthermore, the circumstances under which the business would be subject to direct tax will depend on whether it is incorporated or resident in Nigeria or in a foreign jurisdiction. So if it's incorporated in Nigeria, for instance, it will be taxable on its worldwide profits based on the tax rules in Nigeria. However, if it's incorporated in a foreign country, then its taxability will depend on which foreign country it is resident in and whether the business has a taxable presence in Nigeria. I'm sure we'll get to talk more about that. I had earlier talked about the fact that business can be liable to direct taxes or indirect taxes. Now, talking about indirect taxes, that will cover tax types like withholding tax, value-added tax, custom duties, excise duties, stamp duties, for instance. Those are some of the tax types that will be relevant. And these specific indirect tax types that will be applicable to an online business will depend on the kind of transactions it engages in delivering value to its customers. For instance, does it provide online services or digital goods or physical goods? Does it ship the goods into Nigeria from a foreign country? Or is it even located in Nigeria? So those are the kind of considerations. Talking about indirect taxes, the two major ones that I think would mostly apply to online businesses are withholding tax and value-added tax. So corporate Nigerian customers of online businesses are likely to deduct withholding tax when making payment to that business, and that withholding tax can either be an advance payment of the income tax payable by the online business or the final payment, the final tax, payment in that regard. On the other hand, value-added tax is likely to apply as long as the online business as customers that are resident in Nigeria, and the businesses, goods or services are actually supplied or deemed to be supplied in Nigeria. So I would say that's the general framework: direct taxation, indirect taxation, and then the circumstances of the company, the circumstances of the business rather, the way it's set up, the kind of transactions it engages in. Those are the things that would determine how it will be taxed in Nigeria. I would pause here and hand over to you, Lizzie.
Thanks, Akinwale. That's a very good one. And I think another important factor that needs to be evaluated is the business model of the online business. Because as we know, the traditional brick and mortar is not necessarily the way online businesses transact their business. For instance, you can have situations where the cash flow, the value system of how money transfers from one entity to the other, especially when you have intermediary platforms involved in transactions. So those kind of situations also need specific review, especially when it comes to taxation and the responsibility to collect withholding tax. I think that's another important factor. Okay. Another question is, have foreign online businesses without any physical presence or representative in Nigeria always been taxable in Nigeria?
Thanks, Lizzie. Well, not really. They've not always been taxable in Nigeria. And that's because of the rules applicable in Nigeria. So let me go back to the direct taxation, indirect taxation thing that I began to talk about earlier on. So in Nigeria, the major section of the Income Tax Act, the Companies Income Tax Act, for instance, that affects non-resident companies is Section 13(2) of the CIT Act. That section subjects a non-resident company to tax in Nigeria, well, before it was amended, under 4 scenarios. If the company had a fixed base in Nigeria, or if the company had some form of agency arrangement in Nigeria through which it habitually carried on a trade or business in Nigeria, and then there were 2 other scenarios, which was whether it executed a single contract for surveys, deliveries, installation, or construction, and whether it engaged in transactions with its affiliates in a way that was considered to be artificial or fictitious. For a long time, those were the rules that were applicable in Nigeria. The last time that section of the law was amended was in 1993. At that time, the digital revolution had not even really taken off. Companies like Amazon, Netflix, Tencent, Alibaba, Facebook were not even born at that time. 1993 is a very long time. And so as a result of that, when the digital revolution then took off, especially with the adoption of GSM technology in Nigeria in the early 2000s, and there was then a rapid digitalization of the Nigerian economy. The result of that was that Nigeria's tax laws were not designed to capture non-resident businesses that were doing business in Nigeria without any physical presence. And so for the most part, those companies were not taxable in Nigeria. They were not subject to direct tax in Nigeria. On the indirect tax front, for a long time as well, Nigeria did not have place of supply rules in its value-added tax legislation. As a result of that, it was difficult to determine whether a supply would be deemed to be concluded in Nigeria or not. And there was a lot of controversy that resulted from that. I know many people may be familiar with the case between Vodacom and the Federal Inland Revenue Service in Nigeria that involved a non-resident company that was providing bandwidth capacities remotely from outside Nigeria. But it was, the tax authorities argued that the service was being consumed or concluded in Nigeria. And that case went all the way from the Tax Appeal Tribunal to the Federal High Court to the Court of Appeal. but at the end of the day, there was some decision around it, but the controversy still lingered. And that was why over time, the Nigerian fiscal authorities thought it would be necessary to amend the tax laws in Nigeria. So just to summarize, non-resident companies without physical presence have largely not been taxable in Nigeria up until recently, when the tax laws in Nigeria were amended. Thanks, Lizzie. So over to you.
Apologies, I thought I unmuted. Okay, thanks, Akinwale. So one of the key things that the 2019 Finance Act sought to do was to align, our tax laws with global best practice. And I think that's where a significant update on the taxation of non-resident companies that operate within the digital economy was introduced. So I think we've taken that bold step. The issue is implementation, and I will discuss that in further detail. So I have another question. This one is specifically with respect to VAT. And it says that if a company is in Nigeria and doing online business for a company in Cameroon, should the company in Nigeria include VAT in its invoice to the company in Cameroon?
Okay, thanks, Lizzie. So I think when you begin to talk about cross-border transactions, the important consideration is always the tax laws applicable in the jurisdiction of origin and the destination. So one needs to consider both, in this case, one needs to consider both the tax laws in Nigeria and the tax laws in Cameroon. So for online business that's provided, so I presume that the company is providing online service remotely. In Nigeria, to the extent that the company, the customers that are being serviced are not resident in Nigeria, and they don't have a permanent establishment or taxable presence in Nigeria, the services being provided by the Nigerian online business will be considered to be exported services. And exported services are generally not liable to Nigerian VAT. So Nigerian VAT will not apply in that instance. But one would then need to check the rules in Cameroon and see, how does Cameroon's value-added tax legislation work? If Cameroon's tax legislation, VAT legislation, is similar to that of many countries, it is likely that it would include provisions that may require VAT to be charged. That's Cameroonian VAT now to be charged. And it may require the Cameroonian company to account for the VAT. But, I'm not a specialist in Cameroon's tax legislation, but that would need to be evaluated to know whether Cameroon's VAT would apply. But what's clear is, to the extent that the customers are not tax resident in Nigeria, Nigeria's own VAT will not apply to that transaction.
Okay, thanks for that clarity. So another question that has come up is, what are the major factors you think necessitated Nigeria's decision to tax foreign online businesses?
Okay, well, I think there are a number of factors to consider. The first one is the global evolution of digital businesses. In my introduction, I talked about just how massive global digital businesses have become. I think in 2020, the World Bank had estimated that global online businesses accounted for, or the digital economy now accounts for about 15.5% of the world's economy. And, during your introduction, you talked about how the COVID-19 pandemic has even accelerated online businesses' capacity. So it's possible that that the digital economy could now represent about 20% of the global economy. So that's an important consideration that the tax authorities in Nigeria would have considered. Say, if the global business, if online businesses are evolving so quickly and growing so big, and the Nigerian economy has been heavily digitalized, then there is a need to capture part of that value and ensure that Nigeria gets a fair share of the tax. So that's one consideration. I think the other consideration that's important is the tax morality debate, especially the 2016 ruling by the European Commission that requested that Ireland recoups from Apple about 13 billion euros in unpaid taxes between 2003 and 2014. That debate threw up a lot of conversation about whether multinational enterprises were paying their fair share of taxes in the jurisdictions that they operate in, or in the jurisdictions that they have users or customers in. And many countries began to look at that and say to themselves, what action can we take to capture some of the value that's being created in our country or by users in our country, and ensure that the multinational enterprises pay tax on that value. I think that also resulted in some of the actions that were taken in relation to the base erosion and profit shifting issue. So one of the actions, that's the BEPS Action 1, was about addressing tax challenges arising from the digitalization of the global economy. And, efforts have been made since then, largely by the Organization for Economic Cooperation and Development and other bodies to ensure that there is a framework that is acceptable to all countries, to ensure that the tax rules, the international tax rules are changed, and that online businesses pay their fair share of tax. So I think that's another consideration. Another thing that might have weighed heavily on the minds of Nigeria's fiscal and fiscal authorities and the legislature would be the actions that were being taken by other countries. So you had, for instance, France and Italy introduced their own unilateral actions relating to digital services tax. And you had other countries as well that started to take action or to deliberate on it. The United Kingdom, you had Spain, the Czech Republic, Poland, even, African countries as well, Zimbabwe, Tunisia, they began to talk about finding a way to amend their tax legislation to tax the digital economy. And so I think the Nigerian fiscal authorities would have considered those to say, Nigeria needs to also take action. I think the last consideration would be simply the fact that Nigeria's tax laws were simply outmoded. Like I talked about the corporate income tax legislation, the last time the provision affecting non-resident companies, the last time it was amended was in 1993. That's a long time ago. And so I think the tax authorities just felt it was necessary for the provision to be amended to ensure that the tax legislation in Nigeria kept pace with the realities of business, of how business was being done, the realities of the global economy, and that Nigeria could also subject value being created within its economy to tax. So those are the major factors I think necessitated Nigeria's decision to tax foreign online businesses.
Thanks, Akinwale. It's very obvious that Africa is the new frontiers for development, because if you look at Silicon Valley and the West, you can see that they're reaching some certain level of peak, and that where you can really expect growth is Africa. And in Africa, you can also see Nigeria is really, really coming up in terms of internet penetration, businesses migrating from brick to mortar to the online space. So there's a lot of activity going on in that space, and it's very important that the federal government and the tax authorities recognize this fact, which they have. I mean, the series of the acquisitions that have happened recently in the fintech space is also signaling the fact that payment platforms with telcos and fintech is posturing to show that there's going to be a lot of activity in the digital economy space. For an international company to invest almost $200 million in a fintech company, there must be something that they've seen. They've seen the future, and the future is definitely digital. So the FIRS seems to also be staring into the future. So it's very important that everybody's on that trajectory, both the tax authorities, the companies, and the global economy is just all tending towards that. And Africa needs to be prepared. Nigeria needs to be prepared for the future. So I think, yes, all those points that you mentioned is very important, because there's an avenue for tax leakages if our tax laws are not addressed to stem this tide. And the tax at this point is very important to help sustain the economy. We've talked a lot about the budget and the deficits, and it's very important that it's very obvious that tax will play a very important element in plugging some of these gaps. So this is another way to ensure that tax leakages are plugged, by addressing the tax law. So yes, that's very valid points you've made. So I think we can go into the meat of the details when it comes to taxation of non-residents, since Nigeria has decided to also take their destiny into her hands with this SCP order. Significant economic presence, basically some measure of taxing or creating a nexus to tax the digital economy that don't have a physical presence. So the question goes this way: does the significant economic presence order apply to Nigerian companies that provide digital services as well?
Okay, thanks, Lizzie. Well, the answer to that question would be no. The significant economic presence order does not apply to Nigerian companies. It specifically targets foreign companies, especially those carrying on digital, providing digital services, providing digital goods, and providing certain services, professional consultancy, technical and management services remotely. Those are the companies that are largely being targeted, or that were largely targeted by the significant economic presence order that was issued by Nigeria in 2020. Hi, Lizzie. You seem to be on mute.
Thank you. So it was basically an amendment to our Section 13, which focused on non-resident companies.
Yes.
Okay. Thanks for that. Another question is there any possibility of double taxation of online businesses on account of the significant economic presence regime?
Yes, there is possibility of double taxation on account of the introduction of the significant economic presence regime in Nigeria. But the way to look at it, in my view, is the fact that double taxation or multiple taxation has always occurred. When companies, so if I use the example of a Nigerian company, for instance, I already talked about the fact that a Nigerian company is liable to tax on its global profits. So that means if a Nigerian company carries on business in other jurisdictions, it will be taxable, it will be liable to tax in Nigeria on the profits it derives from those jurisdictions, as well as, and it may also be liable to tax it may also be liable to tax in the country that it is operating in. So there will be double taxation. And that's the same thing that would apply to online businesses. It's just that the possibility of double taxation is really easy, because there are really no borders to cross. And so online businesses that are carrying on business, for instance, in multiple countries, they are likely going to be liable to tax in their country of origin, as the country where the business was set up or incorporated. And if the jurisdiction in which the users of the service or the customers of the company exist, if that jurisdiction has also introduced significant economic presence rules, then that means they would be taxable in that jurisdiction. So if I take the example of Nigeria, that company will be liable to tax in Nigeria if it has significant economic presence in Nigeria, unless maybe, for instance, it is that the foreign company is in a country that has a double tax treaty with Nigeria. So there may be some exceptions in that case. Otherwise, if a foreign company carries on business in Nigeria, it will be liable to tax in Nigeria if it meets the relevant threshold, carries on the services that are covered. And I think I will talk about that in a bit more detail later on. And then that company may also be liable to tax in its own country of incorporation. So the possibility of double taxation exists.
Okay, but what about if the multilateral instruments, for instance, are finalized and you have double tax treaties? There should be some relief there.
Yeah, absolutely. So the way the frameworks are currently being designed, and there is no final decision yet, because I mean there's an inclusive framework that was introduced by the OECD. That was submitted for comments, I think, in the last quarter of 2020. And some of the comments that have been made are that, it's too complex. And in many cases, the tax that will be paid in the countries where the users or the customers of the foreign company are based is too little. So there would still need to be a lot of engagement and discussion about the framework that is being discussed before there would be consensus. So I think, but whenever a consensus is reached, then the consensus should mitigate the risk of double taxation. Based on the current framework, the idea is for part of the profit of the company to be taxed in the country where the customers are, where the users are, and then the company will still be liable to tax in its country of origin. So there will still be more double taxation to an extent, but it will just be minimized.
Okay, thanks, Akmali. So we have a question. This is from Twitter. Our Twitter participants are really active on this chat today, and we thank you. So the question is, we know that the OECD has been working on a consensus approach to the taxation of digital services. However, many countries, including Nigeria, have been making unilateral decisions on this. What are your thoughts exactly on this?
Well, my thoughts on this, are that many countries are concerned that the OECD's consensus approach has taken a bit of time. So the discussions about the BEPS action, one, for instance, started like
2015.
Yeah, more than 4 years ago, and there have been some draft legislation, Pillar 1, so there have been a lot of conversation around how to actually go about it. And then I think many African countries appear to have been, somewhat disappointed by the outcome of the approach, in terms of the fact that it was too complex. It was still going to be difficult to really ensure that the African countries, that have been digitalized, they will get a fair share of tax from the multinational enterprises. And so I think that's why African countries began to take action. So, Nigeria introduced its own significant economic presence regime in 2020. I think Zimbabwe had introduced its own in 2019. Kenya introduced its own significant its own digital services tax, I think January 2021, and other countries are beginning to consider that as well. And, I think what many countries are basically doing, like what you would find in Nigeria's own significant economic presence order, is that whenever a multilateral solution is reached, then that solution, that consensus approach will override the significant economic presence order in Nigeria. So the unilateral measures being taken are essentially a stopgap measure. Countries think it will be difficult for them to wait. And, when one thinks about it from the point of view of the countries, especially when you look at African countries, for instance, where, many of these online businesses are not headquartered in Africa. They are headquartered outside of Africa. But there's a lot of users, a teeming youth population in many African countries. So in Nigeria, for instance, the number of users, number of people that use these online products, it's significant. And so many of the African countries are saying, they may not be able to wait until the consensus solution is designed or finalized. They will take unilateral action, and then that would be superseded by whatever consensus approach that is reached. And the other thing to look at, is the fact that many African economies have been ravaged by COVID-19. And so the likelihood of more countries in Africa trying to introduce significant economic presence regimes or digital services tax regimes is high, because they're trying to see how they can reduce their budget deficits and increase the tax revenues that come from the activities happening within their economies.
Absolutely, Akinwale, I share your sentiments. It looks like the government has recognized that it's an interim measure, and that once there's a consensus that's finally reached, then that consensus will take precedence over the SEP. For the most part, the SEP seems to actually also be modeled after the proposed recommendations with the OECD. But in any event, once that consensus is reached, then the consensus will take precedence over the SCP order, and there'll be no need for the administration of that order any longer. Okay. Another question. This is a very long one, so I will take it in bits. It's from Ravindran. Okay, so it's from Ravindran, and he says that we are in media and communications sector and have a lot of transactions around West and Central Africa. We also do business with global online vendors, such as Facebook, Google, etc. So if we have a client in Cameroon who have engaged the local entity in Cameroon, and they in turn give the work to an entity in Nigeria to book adverts through online vendors, the third-party invoice from Facebook do not have VAT because they are registered in Ireland. Now, the question is, does the Nigerian entity have to charge VAT to the entity in Cameroon when the services are rendered outside Nigeria and online, please?
Okay, thanks, Lizzie. No, I think I already touched on that earlier, and I think it was maybe similar to the question that was asked about whether services provided by a Nigerian company to a customer in Cameroon would be liable to tax. So if a service is provided from Nigeria to a Cameroonian customer, it shouldn't be liable to tax. But in the kind of arrangement that has been described, where there are multiple layers, one would need to then evaluate, is there any form of consumption of service in Nigeria?
Absolutely.
Because if service is being consumed in Nigeria, then Nigerian VAT may apply to a particular layer of the transaction. And one needs to bear in mind the fact that the place of supply rules in Nigeria are very broad. So if services will be deemed to be consumed in Nigeria. So it's not just about the actual consumption of service in Nigeria. Based on the rules, service will be deemed to be consumed in Nigeria if the user, of that service is resident in Nigeria. And so one just needs to consider those layers of transaction to be sure that Nigerian VAT would not apply. But if there's no consumption of service in Nigeria, then there will be no Nigerian VAT because the rules around the supply of service would not kick in Nigeria.
Thanks, Akinwale. Okay, another question from Twitter. It appears that there is no clear framework on the taxation of B2C transactions, especially with respect to VAT. What are your thoughts on this?
Yeah, so you're absolutely right. Or the person that asked the question is right about the fact that there isn't clarity about B2C transactions. So the way the Nigerian VAT regime has been designed is that it just talks about the fact that where, for instance, a non-resident company has provided service to a person in Nigeria. So it uses the word person in Nigeria very loosely. So that person in Nigeria could be a corporate customer, it could be a consumer, that's an individual. If it's provided to a person in Nigeria, obviously VAT will apply based on the place of supply rules in Section 2 of the VAT Act. However, the person in Nigeria is supposed to account for the VAT. So that's where it becomes a bit problematic, because when the user or the consumer is then not even registered for VAT, it's difficult for that user to account for the VAT. But that provision also includes a proviso that empowers the tax authority to appoint someone to account for the VAT. And I'm aware that the tax authorities are currently considering the modalities of requesting that the online service provider, the foreign service provider, in a B2C arrangement should account for the VAT and remit it directly to the Federal Inland Revenue Service. So that's the guidance that the tax authorities are trying to put in place. It is not in force yet, but that's the thinking within government circles about how to address the lacuna that seems to be in the law.
Thanks, Akane. But wouldn't that be a bit problematic in the sense that, for instance, you have a non-resident company selling electronic books, music, and they're in different countries across the globe. So they would, in this particular situation, for instance, in Nigeria, they would need to basically file returns in Nigeria based on this potential proposal that the FRS is exploring to address the issue.
Okay, yeah, thanks, Lizzie. Well, I think the reality is that because of the place of supply rules in Nigeria, non-resident companies, like the example that you've used, providing ebooks, selling digital products to a Nigerian consumer, that kind of company would already be seen as having supplied the good or the service in Nigeria. And once it is deemed to have supplied it in Nigeria, then when you look at the rules, the VAT rules in Nigeria, that non-resident company would be required to register for VAT in Nigeria. So it already has an obligation to register for VAT. It would need to charge VAT on its transactions with Nigerian customers, whether corporate customers or individual customers. So that obligation already exists in the law. Now, the law did not directly place the obligation for the non-resident company to account for the VAT. So that's clear. So that's the only obligation. But the obligation of registration, of charging VAT, or filing VAT returns, those ones are already explicitly in the VAT legislation in Nigeria. And so what the tax authorities are just trying to do is then to leverage the provision of the law in the VAT Act, that's Section 10 of the VAT Act, even the Federal Inland Revenue Service Act as well, to then find a way to get the foreign companies, since they're already registered, and since many of them they tend to be more responsible corporate citizens, than maybe the consumers, because not just in Nigeria, globally, individual consumers tend not to account for VAT. That's why the models, the EU model, for instance, it's the non-resident service provider that accounts for the VAT, not the consumers. So that's what the tax authorities in Nigeria are also trying to leverage, to just add the responsibility for accounting for the VAT on B2C transactions to the other responsibilities that foreign online businesses already have under the law.
Okay. And perhaps they can utilize an agent to help with the filing.
Yes, so in the Finance Act 2020, there was a provision, on the possibility of a foreign company registering through an agent. The framework for that is not clear. So it's not clear whether, for instance, the agent will just be a tax advisor, like what currently obtains, or if it would be a fiscal representative that may even have obligations beyond that of a tax advisor. So the tax authorities are supposed to provide guidance on that, but that guidance is still being awaited.
Okay, thanks, Akinwale. So Arjar is asking that how would one define the taxable income of the SEP? How would you, because when you trigger a significant economic presence, it's the profit that is attributable to that SCP that is liable to tax. So that's the question on everybody's lips. I guess I'll put it in your own lips now to respond while I listen.
Well, okay. So I think, what needs to be said is that in terms of determining which kind of incomes are in scope, one needs to look at the provisions of the law. So if I look at the Companies Income Tax Act, for instance, Section 13(2), the provisions that have been amended, they try to cover two broad categories. They cover digital transactions, or let me just say digital goods and services, and then they also cover services that are provided remotely, four categories. So when one then looks at the significant economic presence order in conjunction with the corporate income, the Companies Income Tax Act, the activities that are in scope, so the first category that I would say would be where a company derives gross turnover exceeding 25 million from streaming or downloading services or digital content, transmission of data that's collected about Nigerian users or generated from their activities, provision of goods or services directly or indirectly through a digital platform, provision of intermediation, services, maybe through a digital platform, a website, online applications. So those ones are in scope. And those are the only categories, in the significant economic presence order to which the 25 million naira threshold specifically applies. The other scenarios in the significant economic presence order that could create significant economic presence for a foreign company, that threshold does not apply to them. And those ones include things like, where a foreign company has a purposeful and sustained interaction with persons in Nigeria by customizing its digital page or platform, so that the users can use it. Maybe it charges in naira, for instance. So that one is also a trigger. And any income that is then derived from that purposeful and sustained interaction of the foreign business with Nigerian users will be in scope for Nigeria. The other scenario, is where the foreign company has a Nigerian domain name, that's .ng, or it registers a website address in Nigeria. And then the fourth category that's mentioned is where the foreign company provides technical, professional, management, or consultancy services in a year and earns income or receives payment from a person in Nigeria, a fixed base in Nigeria, or an agent of a non-resident company in Nigeria. So those are the broad categories of transactions that could trigger significant economic presence for a foreign company in Nigeria. And where a company then has significant economic presence, that means the revenues derived from those activities are potentially taxable in Nigeria. Now, what the tax law says, the Companies Income Tax, what it says is the profits that will be taxable in Nigeria are the profits that can be attributable to the significant economic presence. And I think that's where the challenge kind of starts. That's where there's some form of uncertainty, because the tax law does not define how that profit will be attributed. The significant economic presence order does not define how the profits will be attributed. The FIRS hasn't provided any guidance on how the profits will be attributed. And even the traditional transfer pricing regime does not really address how you attribute profit in a scenario where there is no physical presence in Nigeria. So those are some of the challenges that may throw up uncertainty. So the challenge is really not about the income. It's more of It's more about the profit, because in determining profit, you then need to determine expenses, and how do you determine which expenses will be tax deductible in Nigeria? So there are general rules, for tax deductibility of expenses in Nigeria, but one would need to really look at them within the context of a foreign company. Will it allocate, which allocation keys would be used? Will it allocate cost to Nigeria based on the turnover generated in Nigeria vis-a-vis its global turnover? That's a possible approach to addressing it, but there's no certainty around it because it's not codified. And I think taxpayers are generally looking for more certainty in these areas. That's why in many jurisdictions, the approach that's been adopted is that of a digital services tax, rather than Nigeria's own approach of significant economic presence, which results in payment of companies' income tax. And under a digital services tax regime, I think a flat rate is just charged maybe 1% or 3% in some cases of the revenue, because it's easier to determine the revenue than it is to determine the profit. But hopefully, as the conversation, the debate around the framework, the consensus framework progresses, maybe there will be more clarity. And maybe in Nigeria's own Finance Act 2021, maybe there will be more clarity as well, so that taxpayers have certainty on how they will be taxed in Nigeria.
Thanks, Akinwale. So if I pick up from that, but if we look at the Finance Act for 2020, it does recommend that the non-resident company that has triggered an SCP will be required to prepare financial statements. So both a global financial statement and a localized one for the Nigerian operation. So the FRS is alluding to the fact that the localized Nigerian operation financial statement will sort of create that basis for the profitability or otherwise of the company. It's now seen as to how the auditors or the accountants will come up with that sort of financial statement for Nigerian operations, which would be extracted from the global operations. And that's where, when you mention that a lot of countries that have gone ahead to make this unilateral decision have just basically done a percentage of turnover. You have a range of some from 0.5% to 5% in some instances, and in some instances slightly higher. But I think one key factor is to say that, Nigeria at some point accepted the filing of a non-resident based on deemed income. But then from 2015, that had stopped. So it's to see the interplay between how, filing on a deemed basis perhaps could be accepted for non-residents in this kind of situation, which is basically what is acceptable in other countries that have, imposed the SCP pending when the OECD concludes on their own SCP proposals. So I think it's something that can be explored, the percentage, so that, because taxation has to have that level of certainty. You don't want to send uncertainty to non-resident companies where you can't plan. You can't have an idea of what your tax numbers will look like, because there's a lot of, there's also judgment as to the allocation of expenses. How do you do that? There's a lot of intangibles with this kind of business. How do you allocate intangible expenses across a globe with presence in magnitude of countries? So it's a very important one, because one of those canons of taxation is the clarity and the certainty.
Yeah, I totally agree with you, Lizzie. I totally agree. I think the deemed profit approach, the tax authorities tend to talk about adopting it sometimes as a fallback position, so where, for instance, the tax authorities are not satisfied with the profits that have been reported by a foreign company in respect of its Nigerian operations, the digital operations, then the tax authorities may want to apply the deemed profit approach. But that's kind of it would be problematic, and it's likely to be challenged, because the deemed profit regime was something that generally applied to non-resident companies that had physical presence in Nigeria. And so the profits that would be attributed to Nigeria in a scenario where there's no physical presence, the question would be, how are we sure it should still be 20% that would be applied. Why not 5%? Why not 2%? So what's the science behind it? So that's going to be challenged, and I think the tax authorities would need to be prepared for that, because taxpayers would try to demonstrate that the value that has been created from the maybe network effects, the user base in Nigeria may not be as significant as 20%. So that remains to be seen generally. So many proposals are on the table, and hopefully a consensus approach will be reached soon to really reduce the level of the level of uncertainty that exists in that space. It's not just in Nigeria. There are concerns in some other jurisdictions, but I think the approach that has been adopted by Nigeria and the fact that there's been no guidance so far, kind of throw up a lot of uncertainty and questions in the minds of taxpayers. Even though they have tax obligations in Nigeria, determining how to discharge those obligations is sometimes a bit difficult to navigate.
Thanks, definitely. Okay, Arja is also asking, how does the SCP regulation align to withholding tax regulation? I'd assume customers would continue withholding tax on service payments to NRCs.
Yeah, absolutely. So, in Nigeria, the way the withholding tax regime works is that if a foreign company, for instance, is liable to companies' income tax in Nigeria, then that foreign company is going to be liable to withholding tax in Nigeria. Now, whether that withholding tax will be an advance payment of income tax or the final tax on the income derived will depend on the nature of the income. So in the case of digital service companies, for instance, if you could have a situation where companies are providing online technical services, online management services, online consultancy services, online professional services. And in that case, the provisions in Section 13(2) of the CIT Act will still apply, in which case there will be 10% withholding tax, and that will be the final tax. But where you have other forms of digital services, maybe streaming of movies, of music, and the like, and those are the profits that are being derived from Nigeria, then most likely the withholding tax rate would be 5%, and that withholding tax will be an advance payment of companies' income tax. But in that case, the non-resident company will need to prepare financial statements for its Nigerian operations, and it would need to file tax returns in Nigeria using its global financial statement, the financial statements for its Nigerian operations, and then the self-assessment forms that will be completed, and the tax computations that would need to be prepared. So those would need to be submitted to the tax authority in Nigeria. And those will obviously be reviewed by the tax authorities to ensure that they meet expectation.
Thanks, Akinwale. I think the key distinction is just to say that the guys that provide, the non-resident entities that provide the technical management, professional and consultancy, the withholding tax is the final, so they don't need to file returns. All right, thank you, Akinwale. We have done an hour now, and at this point in time, it will be good to sort of feel the pulse of our guests, our participants, and let's go to the poll. We would be taking a quick advert and then a poll just to sort of get the house talking and moving on this issue. And let's see what our participants think about some of the issues that we've discussed here already.
Okay.
All right, thank you.
This isn't the world you grew up in. You've become an expert in areas of the business that go well beyond tax. Your organization is more global, increasingly digital. Your business models are more complex. Compliance is getting complicated, and penalties are more severe. Governments around the world have moved towards taxes that are easier to collect and administer through technology. Suddenly, your board wants to hear from you about risks and opportunities, and you're not the tax leader you were when you started out. You know how to transform your tax data into meaningful insights. And if you're anything like the other ambitious, future-thinking tax leaders out there, You've managed to do all of this with fewer resources and less budget. Maybe these tools still feel disconnected from one another. Not anymore. Introducing KPMG Digital Gateway, the single platform solution that gives you access to the full suite of KPMG tax and legal technologies you use. Across our global network, we are investing $5 billion over 5 years in technology, people, and innovation to accelerate the digital transformation of KPMG firms and our clients, and more than $1 billion in tax and legal technology specifically in that period. KPMG Digital Gateway puts the fruit of our investments at your fingertips, bringing together the expertise of alliances, technology solutions, and the KPMG global network of professionals into one integrated platform. Putting our investments in machine learning, deep analytics, visualizations, and AI technologies in one place, all driven by the rich data you already have on hand, powered by Microsoft Azure, built on the cloud. KPMG Digital Gateway and the teams behind the solutions are working together to help change the lives of tax leaders and their teams, redefining target operating models and transforming tax functions for the new world order. You've done so much already. Just imagine what the future of tax will be with a platform like this behind you.
Thank you. So that was just a quick advert on our KPMG, Global KPMG Digital Gateway. It's a platform that displays all our technology suites of services. As we've been discussing, the digital economy is the way of the future, and so is taxation also. It's very important that the tax function of every department, of every company is positioned to take advantage of opportunities, because there are risks, there are opportunities, and if you're surrounded with the right kind of solutions, then you can thrive at the same time as unlocking value for your businesses, even with the advent of additional taxes that are being levied on countries and companies. The tax functions can be positioned to unlock value and deploy technology to be more efficient, identify risk proactively, and proffer solutions proactively. So we would at this point like to invite our participants to participate in the polling session. There are 3 methods that you can join. You can either scan the barcode, which is on the right of the screen, or you can go into the chat and pick up, click on the link, or you can just click on the link on there's a website that you can just type into your browser. But I suspect the easiest might be to scan or just pick the link from the chat box.
Okay.
Okay, so we're just going to start the polls now. We have, just a second, please. Okay, thank you. So I can now see we have, which of the following is your favorite social media platform? We have 29 people that have joined the poll. We really want more people to join before we start. This is a teaser question, and a lot of people, at least more people initially preferred LinkedIn. It seems Twitter is now at the top. Which of the following is your favorite social media platform? Twitter, and that's probably why we're getting a lot of questions from Twitter. So we have LinkedIn at 26%. Our participants are not that active on Facebook. Instagram is at 20% now, but it seems like more of our participants are on Twitter. At least we have 37 probably getting up to, at some point, 40% on Twitter, LinkedIn, 29%, Instagram, 20%. It looks like Facebook is at 12%. Okay, we would like to get more people. We invite more people to participate in the polls. As I predicted, Twitter is now at 40%, 41%. It looks like the bird is taking it for the house for today. And then LinkedIn is at 27% and Instagram at 20%. Okay, we have more people coming on, but we could still have more. So we encourage you to join, please. You can pick up the poll in the chat box. You can pick up the link, rather. Okay, so we have about 51 people on the poll now, and we encourage more people to join as we continue. Okay, so we'll proceed with the poll now.
I'll be interested to see what listeners think about the questions.
Okay, so let's proceed. So the first question is, which of these online digital services do you currently use? Please select all that applies. Okay, so we want more people to participate. Video streaming services and transportation are at par, but has changed drastically back to video streaming services at 77%. Transportation follows closely behind. E-commerce at 59%. E-commerce at 57%. Music streaming. Video streaming seems to be definitely taking more here.
Yeah.
We have video streaming as top, and then we have transportation coming after video streaming.
Yeah, I think many people are on Netflix these days.
Yes, but e-commerce, when we say transportation online.
Yeah, so you're talking about an Uber, for instance,
Okay.
The e-hailing services, that basically provide the platform that connects the users to the drivers.
Okay. So we have the video streaming services, e-commerce, which I suspected that e-commerce would come top as well. Then transportation, then music streaming, and then online education and ebook services at 47%. So it looks like video streaming definitely has been consistent at the top, with e-commerce following behind, transportation at 53%, music streaming at 47%, and online education ebook services. So Akinwale, it's very obvious that entertainment plays a very critical role with the digital economy in Nigeria, because we have video streaming consistently at the top, and then e-commerce coming at 58%, transportation at 53%, music streaming 47%. I would have thought music streaming was more. But transport is, as the Ubers have definitely come to change the landscape of transportation. So that also is featuring at 52%. Online education and ebook services at 48%, music streaming at 46%.
Yeah, I think, the interesting thing is, that all the sectors people are basically using all these digital services, and it shows just how pervasive the use of the services have become. They've become part of our day-to-day lives. When you think about eating, you're probably thinking of ordering something online. You think about moving from place to place, you're thinking of an e-hailing service provider. You're probably listening to Spotify while you're on your way. So it just shows how pervasive and the use of these services have become. And I think that's why the fiscal authorities, seeing that these services represent an increasing percentage of our gross domestic product, they decided that it was time to subject that part of the economy to tax, because Nigeria has always had a very low tax to GDP ratio. And it was because some of the transactions generating value in the economy were not being subjected to tax that was responsible for that. So I think that those are some of the reasons why fiscal authorities have looked at that. And these statistics just kind of validate that.
Thanks, Agoy. It's obvious that there's a major intersection between the digital services economy and all sectors of the economy, because
absolutely,
it's just basically in all the economies. So what I was actually reading something that very soon it will no longer be e-commerce, because it will be commerce, and that's that's basically the main way of transacting business. And then all of a sudden, the electronic would not be necessary to mention anymore, because that's the new world order.
Yeah, it would be a given.
Pardon?
I said it would be a given.
I mean, I'm very excited about the future. I can't imagine what the next 10 years. Look at even when we scroll down. Please, could you scroll down a bit? Even the sale I saw about stock and currency trading. Please scroll down.
Scroll down, so you have a very active. You have a very active user base for those services in Nigeria. So whether you are talking about stock trading or you are talking about crypto trading, the Binances, the Lunos of this world, many people are active on those platforms, and that's why you see that featuring here.
Yeah, it's very important that the digital economy is accelerated, because it's just the way of the future in all sectors of the economy. So it's very good that the government has recognized this and taken actions. But as we said, there has to be clarity, and the clarity needs to be timely as well, so that there is not a gap or any level of uncertainty because of planning purposes.
Yeah, and the right balance needs to be struck between the tax administrators and the taxpayers to ensure that what's being taxed. I don't think many foreign online businesses don't want to pay tax in Nigeria. But the question is, what's the fair tax to pay in Nigeria? And that's where the conversation needs to be held at, to ensure that whatever regime is implemented is equitable, it's fair to all the parties concerned.
Okay. All right, thanks, Akinwale. Please, could we have the next question? So do you think it is fair for foreign digital service providers with no physical presence in Nigeria to pay Nigerian income tax on the profits they derive from the provision of services to their Nigerian-based customers? So Akinwale, I'm putting you on the hot seat. Well, not me, actually. Do you think it is fair? Your last sentence was equity and fairness. Mm-hmm. So in the spirit of equity and fairness, do you think it is fair for foreign digital service providers with no physical presence in Nigeria to pay Nigerian income tax on the profits they derive from the provision of services to their Nigerian-based customers? So participants have, they've answered, and 91% of them are saying yes. 9%, it would be nice to understand the 12% that are saying no. Maybe you can put it in the chat box. Why do you think it's not fair? Maybe you can provide context, or actually if you can, I don't know if you can. But 90%, well, it seems like some people have changed their mind, and some people are undecided as to whether it's fair or unfair for foreign digital service providers. I'm surprised, why we went from 90 to 80. It's actually reducing, 83. And then some people are now saying, 14% are saying no. And we have 2% that are still a bit undecided about this issue.
Yeah, I think what's interesting to see is that people are kind of opinionated about this issue. So you see that the percentage of people that are undecided or indifferent is really low. So people are either saying, yes, it's fair for them to be taxed, or no, it's not. And, you know, I like democracy. So maybe I would go with the majority on this and say, well, maybe it's fair for them to be taxed. I think there are arguments to be made by both schools of thought. You know, so when you look at the countries that where these users reside, they're trying to ensure that there is equity between the businesses that are operating in their own jurisdiction and the competitors, because the competitors are now not the physical, are now not companies operating physically, not brick and mortar companies. The competitors are probably in another jurisdiction outside Nigeria. So when the governments look at the fact that the companies operating locally, when they earn profits, they pay tax. The tax comes to the into the treasury, the national treasury. It is used to provide social services, social amenities to citizens that reside in the country. You know, they then want to be sure that there's a level playing field between, you know, the local businesses and the foreign competitors. You know, the way, I think when France was introducing its own digital services tax regime, you know, the way it was phrased, you know, was that the country wanted to ensure that the online business, the foreign online business, was paying tax just like the local bakery, you know, and, you know, that was really the argument, say, well, if the local bakery that has to go through a lot of stress in order to make profits is paying its tax in France, then the foreign companies should pay it too. You know, so I think it's fair for them to pay. The question is then determining the fair amount of tax to pay. And that's where the debate is. That's where the consensus agreement is going to be important, so that there is buy-in from all parties and it can then be implemented globally.
Thanks, Akinwale. Just to contribute, Bolaji Agbola is saying it is fair to pay tax in Nigeria since income is derived in Nigeria. Ravindran says that probably it will be a good idea to have double tax treaty to understand the implications. If they get a relief in resident based out of income generated in Nigeria, then they will not mind to pay tax in Nigeria. Okay. So you've gone with the majority since
on this question, yes, I have.
Okay, we'll stick with that. So let's have the next question, please. Do you think the taxation of foreign digital service providers with no physical presence in Nigeria will result in increased service cost for their Nigerian customers? Do you think the taxation of foreign digital service providers with no physical presence in Nigeria will result in increased service cost for their Nigerian customers? 75% are saying yes. Well, it's increased to 78. No, 19%, and then uncertain at 6%.
You know, this issue is really not just a Nigeria-specific issue, it's a global concern. In all the jurisdictions that are considering or that have implemented digital services tax in one form or the other, there's been this question. You know, when a study was done, I think 2 years ago, you know, the result of the study was that online businesses end up paying only a fraction of the tax. Most of the tax will be passed on to the consumer. So if you take value-added tax, for instance, you know, obviously it's the consumer that is liable to value-added tax. You know, so even though the online business would charge the VAT after registering for VAT in Nigeria, if it collects it, it has to remit it to the government. So it's the user, the consumer, that will pay the tax. So for instance, Canada recently released some framework in its budget that would then result in the introduction of legislation to introduce digital services tax. And the question that many people are also asking is, will this not end up being passed by the foreign businesses to the users? So that dynamic is going to be important. But I think the majority of our participants are probably right that it would result in increased service costs for Nigerian customers. But at the end of the day, if the tax is being collected and collected efficiently, and it is being judiciously used by government, then maybe it will be worth it. And at least those paying the tax, just like all people that currently pay tax when dealing with brick and mortar businesses, they will be able to see the result of the tax they've paid in the improvement of amenities that they use in Nigeria.
Yeah, that's a valid point. Maybe it'll be a win-win situation where you have maybe infrastructure that is updated, you have bandwidth technology that is also updated to help with high-speed internet, for instance, so that when you're purchasing something online, you're hopeful that power doesn't go off when you're just about to pay for that important possession, and then you're not even sure if the payment went through or not. So if perhaps there's some sort of slight increment and you see the benefits, then it could be a win-win situation, because indirect taxes, for most governments is a focus because it's easy to collect. It's supposed to be easier to collect and faster. It's just very important that there's that cohesion between the government and the people, and where they see the benefit of the taxes that are being collected directly.
Exactly. So if you use the example of power, which was part of the focus of the last tax chart that we had, many businesses probably spend more on power than they spend on other kinds of costs. So if they are using digital services and they have increased cost, but the funds being generated are being judiciously used by government, and proper regulations are put in place to ensure that the players in the power sector are able to generate power. The power is transmitted. There is no collapse of the transmission system. Then maybe the operating cost of businesses will reduce, and at least that may even more than offset the additional service costs they've had to pay on digital services they consumed. So it's possible that there will be a win-win position at the end of the day.
Okay. All right, thanks. I think we have a final question, and then okay, so do you think foreign digital service providers are generally aware of their tax, VAT, and transfer pricing obligations in Nigeria?
Okay.
No, 73% are saying no.
No.
And 29, this is a very interesting question.
Yeah. Like I said earlier on, when I was talking about the general framework for the taxation of online businesses in Nigeria, online businesses are generally liable to both direct taxes and indirect taxes. And, for direct tax, that's largely income tax for most of the online businesses that don't have physical presence in Nigeria. And maybe there hasn't been so much publicity or maybe engagement by the tax authorities about the new tax regime in Nigeria. But I know increasingly there is an uptick in the number of foreign digital companies that are making inquiries about the tax regime in Nigeria, that are registering for taxes in Nigeria on account of the services they are providing remotely or digitally in Nigeria. So hopefully there will be more information about the fact that they have companies' income tax obligations. They are required to register in Nigeria for taxes. They are required to prepare tax computations in respect of their operations in Nigeria. They are required to prepare financial statements in respect of their Nigerian operations. And those financial statements have to be attested by a Nigerian accounting firm. And they're required to provide their global audited financial statements as well as part of their tax return. So I think those obligations are there, and obviously they would need to pay companies income tax on the profits that can be attributable to their operations in Nigeria. Hopefully there will be more clarity with time on that. Maybe that clarity will also maybe come from practice, maybe during tax audits, but it will be good if there can be engagement between the tax authorities and tax and non-resident companies in this space, so that there is some understanding, and the concerns are properly aired and they are fully addressed by tax authorities, so that whatever regime is implemented is equitable. And then, talking about VAT, I think we already talked about that. Many non-resident companies providing digital services, they are obviously required to register for VAT, charge VAT. I'm not sure many of them are aware of this, that the VAT landscape in Nigeria is now very broad. Virtually all services that are provided, once the consumer is in Nigeria, there is a taxable presence from a VAT standpoint for the foreign business, and they need to comply with that, because there are stiff penalties. And then even there are also transfer pricing obligations, because many of these companies then need to prepare transfer pricing benchmarks. If there will be any allocation of profits, they will need to prepare transfer pricing returns and file them. And they will need to have transfer pricing documentation in place, the local file, the master file. And depending on the threshold of their global revenue, if it's above 750 million euros, they may even also have country by country reporting obligations in Nigeria. They may need to file C/C notification forms in Nigeria, based on the country by country reporting regulations in Nigeria. So there are a number of obligations. I'm not sure most foreign companies realize this. And again, I'm going to apply my law for democracy and go with the majority.
Okay, so 71% are saying no. I think it will be also important that Nigerian companies that transact with them, foreign companies that do business with them, should also be in a position to also inform them and just sort of keep them abreast as we unravel the magnitude of how much of compliance they need to comply with respect to taxes, especially as it relates to recent regulations and orders, the SCP order and the rest.
Yeah,
okay,
absolutely.
18% are saying yes, that they're aware. And then they potentially may be aware through subsidiaries and related parties. And then 10% are saying no idea.
And okay, I think there's a comment in the chat box that says, that the person thinks non-resident companies are generally aware, but maybe they evaluate the risk, and if they don't think it's significant, maybe the risk of detection is low, they may not act. I think that's definitely one way of looking at it.
Yeah, but you see, the issue now is with withholding tax. So withholding tax has also come, it depends on who they're transacting with. So especially when they're transacting with B2B, then the withholding tax footprints then create some sort of visibility. So it also depends on the nature of their consumers and their customers. But
yeah.
And that's where some practicability about getting non-resident companies into the Nigerian tax net also comes in, with, because there's a vast amount of them. Obviously, FIRS and the tax authorities may be familiar with the popular ones, but there's also, all sorts of online. So it's about are we positioned as, do we have the infrastructure and technology to be able to monitor and administer? And that's where technology, even with the FIRS, the pace at which technology is introduced. Because, for instance, you want an online company to file returns. So the FIRS needs to ensure that their filing portals are working and there's certainty as to when a company is wanting to file them. Because all these are time-bound returns also.
Sure.
So when a company wants to file their tax returns from Sweden, from France, France, from wherever they are, they need the certainty that the FIRS's portal, the tax authorities portal for online filing is working, and there's really no need for a parallel filing. So it's very important that as there's acceleration in taxation of the digital economy, the FIRS is also poised to administer the acceleration of that. I think that will take us to a particular question where someone was also asking about the automated tax system, that would it also, would it have any impact on SEP? Let me see if I can find that question. Okay, I'll have to come back to it because I can't see it now.
Okay.
Okay, so there's another question that says, how does the digital services impact the companies who take digital services in free trade zone? Will they form part of the regular VAT statute?
Could you repeat the question?
How does the digital services impact the companies who take digital services in free trade zone?
Okay, so maybe the person is asking if a free trade zone company, if an approved enterprise operating in a free trade zone procures a digital service from maybe an online service provider, what the regime would be. I think based on the current framework in Nigeria, whether the Nigeria Export Processing Zones Authority Act or the Oil and Gas Export Free Zone Authority Act, there are exemptions under sections 8 and 18 of those pieces of legislation. There are exemptions for free trade zone companies from all taxes, levies, so those exemptions would still apply. The companies will still not be liable to transaction that, to the extent that they are the ones bearing the brunt of the tax, they would not be liable to those taxes. So for instance, VAT should not apply to a free trade zone company as long as the service is being consumed within the free trade zone by virtue of the exemption that is available to that free trade zone company. Withholding tax, whether free trade zone companies should have an obligation to deduct withholding tax based on the law, they don't have that obligation because they are not liable to any tax rules. But from a practical standpoint, whether they may then want to work with tax authorities to help collect the tax, that's another question altogether. So those are the ways I think free trade zone companies would be impacted when they deal with non-resident service providers.
All right, thanks, Akinwale. So I found that question on the automated tax administration solutions. It goes this way. The recent FIRS public notice on deployment of automated tax administration solutions to access records and data stored in electronic devices maintained by taxable persons. Does this also apply to SCP or just few companies in selected sectors?
Well, the way I understand it, the automated tax administration system that the tax authorities has rolled out, I think it's Nigerian incorporated companies that are being used in this pilot phase. So for Tax Pro Max, I think largely it's the Nigerian companies that are first of all being onboarded on Tax Pro Max. Whether that same technology would be used for non-resident companies, I think, maybe the tax authorities would provide clarity on that. What I'm aware of though is that, for foreign digital service providers, the tax authority has some form of online platform in the works, under which those companies may be able to register for VAT without having to fill the physical forms that companies have to fill right now when they want to register for VAT. And those companies will probably also be able to file their returns using that online portal. The tax authority has not launched the portal yet, but I believe the adoption, like you mentioned earlier on, the adoption of technology by the Nigerian tax authorities is going to be critical if they are going to keep pace with the rapid digitalization of the Nigerian economy, if they are going to encourage non-resident companies to be compliant, they have to go online as well, because those companies are not going to think about complying and then be thinking of filing physical returns in Nigeria. It's going to be burdensome, it's going to be expensive, and they would be looking at ways by which tax authorities can deploy technology and enable seamless and easy filing of tax returns and compliance with their tax obligations.
Okay, thanks, Akere. While we're on that, Eniola Bamidele is asking, will the taxation of digital and online businesses not mean that tax authorities may have access to a lot of information, including payment methods and other personal information of both the companies and customers? What are your thoughts on this? I'm just thinking that the privacy rights of companies and customers should be considered.
Yeah, sure. I think in Nigeria, there are data protection rules, that were put in place a couple of years back. And companies are supposed to comply with the data protection regulations. And where there is a violation, there are significant fines. The fines are put in place to ensure that companies take data privacy, data protection very serious. And I think many companies would need to do that. The tax authorities themselves have to invest in protecting whatever information that become available to them. They need to invest in ramping up cyber security protection so that they are not vulnerable to attacks from activists that may want to exploit data and compromise the integrity of the tax system in Nigeria. So the tax authorities need to invest in that and ensure that they also respect data rights. The Finance Act 2020 introduced some provisions to also ensure that tax authorities are held more accountable in terms of the confidentiality rules applicable. So if there's violation, a tax official could be exposed to fines, even imprisonment, if they compromise the integrity of confidential information that become available to them. So I think those are some of the ways in which the tax laws have tried to take care of it. And the tax authorities just need to continue to invest in ensuring that their people and their processes are void of vulnerabilities.
Okay, all right, thanks, Akinwumi, for that. Another question that has come up is, considering the projected size of the digital economy, how can the Federal Inland Revenue Service leverage technology to optimize tax compliance and collection? I think we've broached on that a bit.
Yes, we have. So it's just about, the tax authorities need to deal with these businesses in their own terrain. These are digital businesses. So the tax authorities need to be digital, needs to adopt digital systems, and also ensure transparency, because today you have a situation where taxes are deducted from companies, and it's really difficult for companies to know how much taxes have been deducted so that they can offset those against whatever income tax liabilities they have. When dealing with online businesses, tax authorities have to be transparent. If those businesses have already suffered withholding tax, the tax authorities can't expect them to pay the full amount of income tax without them being able to utilize whatever withholding tax credits they have. So the system needs to be real time. As taxes are being deducted at source, it needs to be reflected, so that the foreign company, because those are the systems in the jurisdictions they operate in. So that's the same thing they would expect to apply in Nigeria or in any country where they operate. So the tax authorities need to step up their game to ensure that the quality of service that's been provided, the quality of the technology that's being deployed, the reliability, of the technology, is top notch, and it's up to, meets the standard that's expected by these foreign companies. And foreign companies are then able to easily discharge their duties. Once the cost of compliance to a foreign company is low, it really encourages compliance, and tax authorities need to be aware of that.
Okay, thanks, Akinwale. What is Nigeria's position on the multilateral efforts being made by the OECD to address tax challenges arising from the digitalization of the economy?
Okay, thanks. No, I think what's being done by Nigeria is to contribute to the conversation. So I know the Nigerian tax authorities are invested in the process as part of the Africa Tax Administration Forum. There are a lot of conversations going on the weaknesses or the demerits that have been noticed in the proposed OECD framework. I'm aware that, for instance, the Africa Tax Administration Forum has already provided has made some proposals on a kind of upgraded option that can be adopted to ensure that there's fairness both to the multinational enterprises and to the jurisdictions in which they have customers. So there's engagement by the Nigerian Tax Authority as part of the ATAF coalition. I also know that in the significant economic presence order that was issued by Nigeria, there is a provision there that says that a foreign company that is covered by a multilateral agreement or consensus agreement, to address the tax challenges of the digitalization of the economy, will not be brought under this the significant economic presence order in Nigeria. So there is already a proactive provision in the significant economic presence order that contemplates that a consensus solution will be reached, and that consensus solution will supersede the existing significant economic presence regime that Nigeria has put in place as a stopgap measure. And like you mentioned earlier on, Nigeria's significant economic presence order is in tandem with the initial draft that was proposed by the OECD in terms of, the kind of transactions that are in scope, that will be taxable in a country where foreign companies have significant economic presence. So I think there's largely consistency between the significant economic presence order in Nigeria and the general thinking of digital service providers around the world. And when a consensus solution is eventually reached, that will be adopted by Nigeria. I think that's the stance of the tax authorities in Nigeria.
Okay, thanks, Akinwale. The other question that has arisen is, does Nigeria's significant economic presence regime currently apply to non-resident individuals that provide online services to Nigerian customers?
Okay, thanks for the question. Yeah. No, the significant economic presence regime in Nigeria does not currently apply to individuals, but it may soon, because, the current regime that applies was introduced by the Companies Income Tax Act, and it required the Minister of Finance to then issue a significant economic presence order, which was issued in 2020. The order was made available to the public, was in the public domain around May of 2020, but it has an effective date of 3rd of February 2020. I'm not currently aware that so in the Finance Act 2020, there was a provision in the Personal Income Tax Act that introduced a new section, and that section basically indicated that non-resident individuals, executors, and trustees, they would have significant economic presence in Nigeria where they are providing technical, management, consultancy, or professional services to persons that are resident in Nigeria. So that provision is there, and that those foreign individuals, non-resident individuals, executors, and trustees, they will be liable to a withholding tax of 10%, which will be their final tax in Nigeria. But there is a requirement for the Minister of the Honorable Minister of Finance, Budget, and National Planning to issue an order to define the scenarios under which those companies would have significant economic presence. So the expectation is that that order will be issued this year. We don't know if it has been issued already, but it's not in the public domain currently. That's what's obvious. So one would just wait for the minister to make public or to issue the order, and then obviously foreign individuals that meet the criteria specified in the order will become taxable in Nigeria, but what the withholding tax that will be deducted from them will be the final tax on their income.
All right, thanks. I think it's just important that they find out what this threshold is, as the SEP order defined the threshold for companies.
Sure.
Okay. All right, we have another question. This is from Ravindran. He's saying that, what about companies supplying services to online platform? Let us say in the media space, there are a lot of things that just go with just an advert placed on a portal. There is content production, etc., which will be an input. What is tax authorities discussing about those inputs to the digital platform? Maybe.
Okay. Oh, okay. Well, I think, if the input is being provided by a Nigerian company, based on the framework for taxation in Nigeria, whatever profits earned by a Nigerian company from anywhere in the world is taxable in Nigeria. So that would obviously, so whatever profits that are derived by a Nigerian business from providing input to digital service providers will be taxable in Nigeria. That's clear. If the person providing the input, or if the business providing the input is a foreign company, then that would need to be evaluated in light of the significant economic presence order in Nigeria. And if the input, if the digital service provider is resident in Nigeria, the input that is being provided by a foreign content provider will most likely be deemed to be consumed in Nigeria. And that would have implications, because then it would be that foreign content provider may be seen to have derived income, from a digital service or a digital content or digital product that was provided to a company in Nigeria, a company resident in Nigeria. So that would need to be evaluated, and because that foreign content provider may then be taxable in Nigeria. The other thing to look at is the value-added tax implication of the transaction, where the supply of that content may deem to have been consummated in Nigeria. And based on the broad definitions in the Finance Act 2020, Nigerian VAT would most likely apply where the content was provided to a digital service provider that is based in Nigeria. So those are my thoughts about that question.
Okay, thanks, Akinwale. So we're finally coming to a conclusion of our May edition of the Tax Chat. We have one or two questions left. At this point, I'll just take one more question, and then there's another one that has been generated organically. So in your opinion, should foreign digital service providers that are tax residents in countries that have a double tax treaty with Nigeria be subject to significant economic presence regime in Nigeria?
Okay, so my view about that is that those companies should not be subject to the significant economic presence regime in Nigeria. And the reason for that is simple. When you look at the significant economic presence regime in Nigeria, it's under the Companies Income Tax Act in Nigeria. And the double tax treaty covers companies' income tax. If you look at Article 2 of most of of all the double tax treaties that Nigeria has with treaty partners, the company's income tax is one of the tax legislation that are in scope. So when you also look at Section 13(2), it covers profits derived from a trade or business. And the provisions on significant economic presence have then been introduced as scenarios under which profits from a trade or business may be liable to tax under Nigeria's domestic legislation. So what's clear is those profits are business profits. And when you then look at the double tax treaty that Nigeria has with treaty partners, Article 7 of the treaty covers business profits. And under the article, the profits of a company that is tax resident in a treaty state will only be taxable in Nigeria if that company has a permanent establishment in Nigeria. So there's no mention of the word significant economic presence. What is required is a permanent establishment. And so the question is, what is a permanent establishment? And that is explicitly defined in Article 5 of the double tax treaties that Nigeria has with treaty partners. And under Article 5, there's no mention of significant economic presence. The provisions there are the ones that have always been, and until they are changed, to my mind, I don't think foreign digital service providers that are tax resident in treaty countries, would have significant economic presence or be required to pay tax under the significant economic presence regime in Nigeria, to the extent that they don't have permanent establishment in Nigeria. So those are my thoughts on that issue.
Yeah, absolutely. I agree with you. I know it's a controversial topic, but to the extent that the treaty has supremacy over the local legislation, then if that treaty has not triggered a permanent establishment for the other country, then it should follow that the SCP should not apply, because as you mentioned, the SCP is an extension of companies' income tax. It's just an amendment to Section 13. And if the DTT hasn't identified an SCP as the basis for which you would be having a permanent establishment in Nigeria, then it should follow. Although it's important to know, it's actually controversial because some people argue otherwise, that to the extent that the DTT has not been amended. I think there would be a lot of benefit from the multilateral agreements, instruments, once there's an update, so that the DTTs can be updated and then there's an alignment. And once that alignment or cohesion occurs, then that controversy may be tapered down.
Well, regarding the double tax treaties, there's already some work being done, because I'm aware, for instance, that the UN, one of the UN's committee, the United Nations Committee on Taxation, approved the introduction of a new article into the UN Model Tax Convention. And if that article is then adopted by countries, that article will address things relating to automated payment services, which are some of the forms of digital services being provided. So I think the UN, and I think there will be a 2021 version of the UN Model Tax Convention that will be released, and that article will be included there, and the commentary will be included. Those have already been approved in April 2021. So there's some thinking along those lines of beginning to modify model tax conventions to reflect the current economic realities. But but even when the model tax convention is updated, countries will still need to negotiate bilaterally. If there are treaties that are in existence, for there to be a change to the treaty, both parties need to negotiate it. And so that will need to be done. The other thing to say is, part of the action of BEPS action plans and the outcome was to ensure that there will be multilateral instruments that once adopted by countries will automatically modify the existing double tax treaties. So it will be interesting to see how the OECD work goes on, how a consensus framework is reached, and how the multilateral framework can then be used as a way to easily update tax treaties without having to negotiate bilaterally. But as things stand today, the current treaties, the way they are, would have to prevail.
Yeah, the multilateral instruments would definitely be more efficient, because it would be more like an overriding instrument that will now update the respective DTTs, and that way is more efficient and faster.
Yeah, and Nigeria is a signatory to it. So once there's progress made in that regard, I think it should be easy.
Okay. All right, so fingers crossed. There's a lot of expectation on the OECD, G20, and the BEPS inclusive framework for this cohesive, because it's important to note that, I mean, as we all know, the world is a global economy now. You know, different people are operating borderless. So we can, in doing this in isolation on the long term may not prove beneficial. So it's important that there's the handshake, the cohesion of the global tax system, the international tax system. There's also Pillar 2 that talks about the global minimum tax, and those proposals are still under review. So it's very important that things are moved on hastily. I mean, the COVID-19 pandemic definitely caused a bit of delay, but hopefully within the course of 2021, there should be some sort of significant milestone as to the proposals and the implementation of BEPS Action Point 1. So Akinwale, I must thank you for your time today, and our distinguished guest panelists on Twitter, on Facebook, on Zoom. It's been a pleasure interacting with you today on our May tax chat, which has been very interesting. We look forward to seeing you in our next tax chat, and we want this to be continuous, so we encourage you to interact with us on our social media platforms, either on Twitter, on Facebook, and definitely on LinkedIn, and so that we can keep the conversation going. If there are any questions that we haven't responded to, we'll be sure to respond to. I see a comment from Ravindra asking for our emails and thanking us. We appreciate your time as well. We'll be sure to contact you. If you've registered, we have your details, so we can forward our email addresses to you. We've engaged with you for 2 hours, and we must say it has been a very interesting session, and there's a lot to look forward to with the digital economy and taxation, and we're looking forward to engaging with you on a long-term basis. So Akinwale, over to you. Thank you.
Yeah, thanks a lot, Lizzie. I think it's been a very interesting session. It's been interesting to see people's perspectives on the various survey questions that we took, and hopefully people have gained some insights. There's more clarity. Online businesses are aware of their obligations, direct tax, indirect tax, transfer pricing obligations. And, in KPMG, we are always happy to assist companies comply with their tax obligations. So we look forward to continuing the conversation. Questions, I'll still answer the outstanding questions on my Twitter handle. So I would look at them, and we look forward to engaging further. And hopefully there would be clarity very soon on the consensus framework, and there will be certainty, the certainty that tax authorities, that taxpayers want very much. So questions can be sent to me on my email address. That's Akinwale, that's AKINWALE.ALAO@ng.kpmg.com. Any questions sent, I would attend to them personally and would get back to them. That's akinwale.alao@ng.kpmg.com. You can also, questions that are sent to my Twitter, and that's @King_Wales, would also be attended to. So we look forward to engaging further and providing further insights as we continue this discussion. Thank you very much, and have a wonderful day. Bye.
Thank you very much, Akinwale. So we'll just be playing our KPMG tax app advert. It's just another way by which we can keep in touch with you and for you to get insights and updates on recent happenings or developments in the tax world. It's an app that you can download either on the Android or Apple phone. So we look forward to also engaging on you on that platform. Have a great afternoon. Thank you all, and goodbye.
Yeah, thank you all. Bye.
Learn on the go and stay informed. Our goal is to keep the average user informed and up to date with relevant tax information. For the entrepreneur and investor, getting acquainted with tax laws and regulations could be quite daunting. Well, not anymore. Introducing the KPMG Tax mobile app, where you can access all tax-related news, laws, and insights in one place. Also, calculating personal income taxes has never been quicker. To get the app, simply search for KPMG Nigeria Tax on Google Play Store or iOS Store and install. Once installed, quickly do a one-time sign-up on the application to access a constantly updated library of news, laws, and articles alongside easy-to-use tools. The KPMG Tax mobile app has a minimalist design, making it effortless to use and navigate. What's more, if you can't find what you need, asking a professional is as fast as it gets. Let's walk you through the application. The full menu is accessible from the left and helps you jump to any part of the application in seconds. Access fresh tax news by clicking on the news icon. The seamless scroll makes it simple to view all news at a glance. You have news you've already seen and want to go back to? Just search. Expand or share each news item to your friends with the dedicated buttons. Adjust your news preference easily from the settings icon and tailor your content. We have embedded tax legislation and popular cases in our tax laws section. Are you eager to know more about taxation in Nigeria? KPMG Tax app has more than enough for you. Stay on the cutting edge of industry updates with insights features. The new app brings together alerts, newsletters, articles, and publications from industry-leading KPMG professionals. You don't have to worry about missing important regulatory dates and other notable events. The notable date feature brings them all into one place in a calendar or list, however you want to view them. For the average employee, entrepreneur, or business person, KPMG Tax app has another important feature, the PIT calculator. Plug and play, simple as it gets. Input the required numbers and calculate your taxes. Also, the app has jokes and valuable tips. Check in to learn something new and fun. Still feel there's more to know? We've got your back. Ask an expert and get quick, insightful responses from KPMG professionals when in doubt. Learn more from various authorities through recommended links in the external links tab. Read all about us to find out more about KPMG's service offerings, our responsible tax principles, and disclaimer. It's now a breeze to connect with us online. Just click on the link icon on the homepage to get to us on social media. KPMG Tax app, connecting with you on the go.
This isn't the world you grew up in. You've become an expert in areas of the business that go well beyond tax. Your organization is more global, increasingly digital. Your business models are more complex. Compliance is getting complicated, and penalties are more severe. Governments around the world have moved towards taxes that are easier to collect and administer through technology. Suddenly, your board wants to hear from you about risks and opportunities. And you're not the tax leader you were when you started out. You know how to transform your tax data into meaningful insights. And if you're anything like the other ambitious, future-thinking tax leaders out there, you've managed to do all of this with fewer resources and less budget. Maybe these tools still feel disconnected from one another. Not anymore. Introducing KPMG Digital Gateway, the single platform solution that gives you access to the full suite of KPMG tax and legal technologies you use. Across our global network, we are investing $5 billion over 5 years in technology, people, and innovation to accelerate the digital transformation of KPMG firms and our clients, and more than $1 billion in tax and legal technology specifically in that period. KPMG Digital Gateway puts the fruit of our investments at your fingertips. bringing together the expertise of alliances, technology solutions, and the KPMG global network of professionals into one integrated platform. Putting our investments in machine learning, deep analytics, visualizations, and AI technologies in one place. Already have on hand, powered by Microsoft Azure, built on the cloud. KPMG Digital Gateway and the teams behind the solutions are working together to help change the lives of tax leaders and their teams, redefining target operating models and transforming tax functions for the new world order. You've done so much already. Just imagine what the future of tax will be with a platform like this behind you.